Hi, O'Connor. Yes, you got me. And we are at chapter 13, and you're probably wondering, wow, when are we going to get away from all these financial statement frauds? Well, not just yet. This will have to be broken into two parts again because there's a lot of case detail to go through. Let's have a look at the learning objectives of this chapter 13. Liability, asset, and inadequate disclosure frauds. Well, we want you to be able to identify fraudulent schemes that understate liabilities, discuss the understatement of liabilities fraud, understand overstatement of assets fraud, list of fraudulent schemes that inadequately disclose financial statement information, and explain inadequate disclosure fraud. As we have done in chapter 12, we looked at the fraud schemes, we look at the symptoms and the ways to follow up. Let's get into this, shall we? And let's start with our cases. Yes, there we have our top 25. Now, as you learnt in the last chapter, there are some other cases that could fit into this 25, making the top 30. I would have to do a bit more research on that. But for now, the patterns are plain to see. If we look understatement of liability that we're going to look through in this first part, in the next part, we're going to look at overstatement of assets and inadequate disclosure. They make up 8, 12, and 9 instances across these billion-dollar frauds. In more detail, and I expand the list to include only those focusing on understated liabilities, then we have frauds that are less than 1 billion and a lot of less than 100 million. The list expands considerably. Why did I do this? Because I want to show you that how the fraud was executed in a variety of ways that we will look at in this part, but also how the fraud was uncovered. And the whistleblower played a part in half of the cases. And there were other investigations external to the firm that followed up on whistleblower allegations to uncover. And this is where fraud investigation creates its true worth. And that is following up on symptoms, following up on whistleblower tips to really get to the heart of what is the fraud going on here. And so, as I said in the last chapter, we want to go through case examples so you can get a real idea of how frauds were executed rather than learning every single type of approach to executing fraud. You can read the textbook to find out all about that and memorize it, but it's better that you understand it from a case-by-case basis. All right, so let's have a look at the top 19 understated liability frauds. How was it executed? Most popularly, they failed to record liabilities, all right? There were complex off-balance sheet financing, and we know Enron was famous for that, along with other companies. And if we look at the waste management scandal, and that is a big case shown at the beginning of chapter 13, where they improperly inflated their operating income and other measures of performance by deferring current period operating expenses into the future. How can you do that? Well, you, instead of expensing, you create or move the expense into an asset. And one way of doing that is by understating depreciation, by deferring expenses, by improperly capitalizing expenses when they should have been expensed and gone through the income statement. When you do every one of these, it makes the income higher. Right. So do read the waste management scandal case. I think it's a nice opener to chapter 13. In the end, what were the losses? 1.7 billion. Okay, so that's a big one. Yes, it should be in the top 25. It is in the top 25. At its time, the mid-90s, it was one of the largest financial frauds at that time, 1.7 billion. And who would have known that by the 2000s, they would have just gotten larger and larger. Wow. Waste management scandal. Check that out at the beginning of chapter 13. There are ways to manipulate liabilities. the Xerox Corporation, the Sunbeam Corporation, W.R. Grace & Co., they were charged by the SEC for using cookie jar reserves. What do we mean? It's rather than recognizing income in the current period in which you earned it, you may store it as an asset to realize it in future periods. These companies recorded extra liabilities, such as recording income as deferred income when results were better than expected, or when management decided to take what is known as a big bath. A big bath meaning, let's move our income as much as we can into deferred income, right? So you're going to debit income, you're going to credit deferred income, then make the liabilities ginormous deliberately to show that, wow, our operations, our revenue are really, really bad this period. But we've got a strategy. We're going to do better in the coming 3 to 5 years. And we know we're going to do better. We know we're going to deliver on shareholder expectations. And you know why? Because we have these cookie jar reserves. We have this deferred income that we can release into income in the next year, in the year after, in the year after, to add on to operations that happen in those years. So that's what we mean by cookie jar reserves. Identifying the understatement of liability fraud exposures. The easiest way to identify the understatement of liability fraud exposures is to identify the various transactions that involve liabilities and can be understated. Again, like we did in chapter 12, we're going to look at the different steps in the transactions involved. As you can see in this table, we can purchase inventory and we can understate accounts payable at the time of the purchase. And the Serena Apparel Group case, they held over ended quarter closing date for sales, but not for expenses. What they did was, for the end of this quarter, maybe the end of June quarter, let's make sure that any sales that occur in the first 3-4 days of July are recorded, brought forward to the closing date of 30th of June. That's what we mean by bringing forward sales. But any of the expenses associated with the first 3 or 4 days of selling in July, let's leave that in the future period. So that's going to push up revenue and that's going to push down expenses that are related to that revenue, because those expenses are deferred into the next year. Other ways are to incur payroll and other accrued liabilities. So again, we want to understate liabilities again. In other words, we don't record any of these accrued liabilities. And this is really dangerous. This is more dangerous than revenue fraud or inventory fraud. You know why? Because you get into trouble with the tax administrators, and then you get into trouble with federal tax law in your country. And the consequences, the liabilities, the criminal consequences, the fines, the jail time could be even larger than just accounting fraud and being caught by the SEC. So be careful about this one. Stay away from this one as a way of manipulating your liabilities. We could sell products, and again, we can record unearned revenues as earned revenues, and we can do vice versa when creating cookie jar reserves. Again, the fraud schemes are about recording payables in a subsequent period. They are about not recording accrued liabilities. They are about bringing forward unearned revenues, but not unincurred expenses. All right. So these are different fraud schemes associated with manipulating the liability accounts, but stay away from that middle one, because you'll have the tax authorities chasing your tail. Other examples of transactions by not recording warranty liabilities. So if you're a car manufacturer, you sell cars, there are liabilities associated with warranties that you give with the sale of the car. For example, you buy a Kia or a Hyundai, you get 7 years maintenance free. you buy another car, you might get 10 years free, like Mitsubishi Motors was offering. Then they have to have a contingent liability for these warranties. If you don't record that, then you are understating your liabilities. Not recording various types of debt. And there's a number of examples here. An omission of contingent liabilities, probably related to the warranty expense and warranty or service liability, but they separate this here in chapter 13 of the textbook. But you know what I'm talking about when we talk about contingent liabilities. It's contingent on an event happening in the future. And so in this one, it may not be recording a liability associated with a ongoing court case, that 50% probability of you losing and having to pay out damages. So if you don't record that, then you are understating your liabilities. The Pfizer case, they failed to record the contingent liability of the Shelley heart valves. Like, there were hundreds of them sold and failed, and there were huge damages awarded in the end. But during the time of the sales, they didn't record at any time the contingencies associated with their heart valve failure. So you can see that some of the themes coming out from these frauds are associated with the failure of products that you sell in the future, and not recording that failure as a contingent liability on your current day books. Let's have a look at the data again. Notice that the most common frauds were understating accruals or reserves, fictitious profits, revenue and assets, and complex off-book transactions. All right, so you can see that there's a whole range of fraud symptoms here associated with the understatement of liability frauds. And as I said, it's not like you have to learn every one of these, but go back, have a look at some cases to understand how any of these frauds were perpetrated. Again, if we're looking for symptoms, most of the symptoms are going to show up in the accounts documentation, as well as the analytical symptoms, less so internal controls, even less so the behavior and the extravagant lifestyle of the fraudsters. As you can go through here, there's a lot of examples of analytical symptoms. Balances appear too low, unearned liability balances appear too low, and revenue accounts appear too high. Again, under-recording and non-recording of service warranties. The balances in warranty repurchases or deposits accounts appear too low. If you have a warranty on your product, as an auditor, fraud investigator, there should be some allowance made for future warranty claims. And if there's not, then obviously there is a red flag. Analytical symptoms, unrecorded notes, mortgages. Again, more examples of what you can look for as a fraud investigator. Accounting or documentary symptoms. Again, that's where you're going to look for documents to support various entries in the liabilities. Photocopied purchase-related records where originals should exist. Unusual discrepancies between entities' records and confirmation replies. Transactions not recorded in a complete or timely manner, or improperly recorded as to amount. If we look at the top 19 understated liability frauds, notice internal audit investigations found them out. External investigations found them out. SEC regulator investigators found them out. Less so, but if put them together, confessions or whistleblower allegations, if you add them together, then that would make up 4 out of the number of cases out of the 19. But again, here we have tax examination. Remember, stay away from payroll tax fraud. All right, you're going to be chased by the SEC, you're going to be chased by the tax authorities. You don't want double trouble. If we look at proactively searching for symptoms related to the underreporting of liabilities, again, we can look within the statements looking for relationships between accounts in the balance sheet, in the profit and loss, horizontal and vertical analysis, or we can compare financial statement amounts or relationships with related information. Again, relating it to details, physical details of the firm's operations, relating to sales of products. If the sales of products go up, the warranty, the contingent warranty claims needs to go up as a liability. And here you're comparing financial results and trends of the company with those of similar firms in the same industry. So you can compare car makers with car makers. You can compare computer sales companies with other computer sales companies, service companies with service companies. Again, assuming you can get information, especially for public available information of publicly listed companies, that is available. For private companies, a little bit more difficult, but that's just a matter of if you're a fraud investigator with specialized industry knowledge, then you would already have that information to compare with the company that you are investigating. So this is listing out what was shown in the table where we do horizontal and vertical analysis. Table 13.3 again looks at ratios used in detecting fraud. And this goes over 2 slides, so we won't look at all the ratios. But when we are under recording accounts payable, then any of the accounts related ratios are going to be important to examine. And you can have a look at how the ratios have changed over time, or how the ratios should look compared to the industry standard. If we look at under recording accrued liabilities, including salaries, payroll taxes, interest, and rent, then there's going to be other ratios associated with the various accruals to examine. If we look at the under recording of unearned revenues or the under recording of service warranties, again, we can look at unearned revenue as a percentage of revenue or warranty expenses as a percentage of sales. These ratios are really handy for looking at unusual patterns or discrepancies in the financial statements from period to period and within each period. Closing out these ratio tables, the under recording of various liabilities, again, longer term debt to stockholders' equity, total liabilities to total assets, lease expenses to total fixed assets. As you can see, these ratios will reveal a lot about the liabilities. This is some more detail in the textbook about comparing financial statement information with other companies or comparing financial statement amounts with assets they are supposed to represent or with non-financial statement factors. Let's go to the final stage of actively searching for understatement of liabilities. Accounting and documentary symptoms. The specific documentary symptoms you search for vary according to the liability that is understated. For example, if the understatement is accounts payable, then you're looking for documents associated with the accounts transactions. If the accrued liabilities is the liability subject to understatement, then you're looking for documents associated with HR. You're looking for vendor statements. You're looking for loans with no interest. If it's unearned revenues, then you're looking for documentation associated with the end of period or near the end of period entries. Documentation associated with differences between customer confirmations and company records about how much revenue has been earned. Again, documentary symptoms of fraud. You're looking for documents depending on the types of liability that are subject to being understated. So the first step is to analytically look at ratios, look for accounts that look strange, out of the extraordinary, and then look for documentary evidence associated with those accounts. So if service, warranty liabilities, deposits look strange, then that's prima facie evidence that there may be something going on in this area and not other areas. And so then you can hone in and zoom in on 14, 15, 16, and 17 and not waste your time on 18 to 29. So that's how the ratio analysis helps you to focus in on the documentary symptoms of fraud. So that finishes the first part where we look at the understatement of liabilities. And we want to understate our liabilities because it makes the company look stronger. It makes the company look solid and less prone to bankruptcy. The debt to equity ratio is lower, so it doesn't look like it's financially stretched. These are all motivations for why management may understate liabilities. And I showed you dozens of companies that have understated their liabilities and how they have done it. What the textbook in chapter 13 shows you is the transaction steps that are involved in the recording of liabilities to look for various ratios of the accounts that look unusual, and then to follow up in terms of the documentary symptoms that will be related to those accounts in uncovering that type of fraud. This finishes part 1. Stay tuned for part 2, where I take you through the overstatement of asset fraud and the non-statement or the understatement of disclosure frauds. Stay tuned. See you soon.